Even after the extension of the US tariff pause, uncertainty on who will bear the costs of tariffs means even greater dispersion in returns, and more opportunity to earn alpha, or above benchmark returns. Wherever tariff levels land, some companies will be better able to pass on the cost than others, and we think this will boost already elevated dispersion. And unlike when the macro environment was more stable, persistent factor exposures, such as to growth or value or inflation, can now hurt portfolios. For investors, we think this requires watching for unintended static factor exposures and deploying active strategies to capture the additional alpha on offer. What's one way to do that? Reduce any drag from factor exposures by deliberately managing macro risk. Now that can mean pivoting quickly as the macro situation changes, or leaning against market panic. In both cases, it means understanding the current macro environment and being decisive as to whether or not you stick or twist with current allocations. Another approach to capturing alpha, avoiding macro factor risk in favor of security-specific risk. Even within the Magnificent Seven of mostly big tech companies, we're starting to see increased dispersion as certain companies capture the greatest benefits from the build-out of AI infrastructure and AI adoption. That creates alpha opportunities for those with insight into potential winners. We stick with our current overweight to US stocks. Market volatility hasn't shown up in US corporate earnings, and underlying economic conditions haven't changed much for now.